Fortune favors the bold, which is why billionaire Eric Sprott and legendary investor Rick Rule are taking advantage of the lowest valuations in the mining sector in over 3 decades by accumulating millions of shares of this tiny new stock led by Keith Neumeyer, a mining entrepreneur who has already built 2 separate billion-dollar companies. This new venture, starting with 18 assets on day 1, including gold, silver, copper, and zinc projects, has already identified 60 additional quality assets in distressed companies that management will work to acquire. To learn more about this incredible opportunity, visit futuremoneytrends.com/fortune. Greetings and thank you for joining us at futuremoneytrends.com. I'm here with a special guest, the CEO of what I believe is the only financial advisory company that is making it a point to hone in and focus on personal finance, strategic retirement investments for the new economy. He's a fiduciary advisor, which is basically means he's in the 4% for advisors. He does not work off commission. He does not get paid by the companies, the mutual fund companies, or anyone to do business with his clients. He charges a simple fee for his work. He's an experienced value investor. Nicholas Green, CEO and Chief Advisor for FMTadvisory.com. Nick, thank you so much for joining us, sir.
Thanks a bunch for having me on your show, Daniel. It's a pleasure to be here on Future Money Trends. And I love the program.
Well, thanks so much, sir. Well, hey, we haven't talked in a few months, and on the show at least, and I wanted to just kind of get your thoughts on the current environment out there. The markets have pretty much recovered. The rate hike, decision, big shocker, that was canceled, but now there's even buffoonery going on out there that there's going to be a potential hike in December, which I personally think is 0%. What are your thoughts on the current U.S. economy, the idea that the Fed's going to raise interest rates imminently?
Okay, so that's a whole can of worms right there, and I'm more than happy to discuss that. I would agree that the Fed will have a really hard time raising interest rates in any systematic way. For example, going from 1/4% to 0.75%, 1.5%. They'll have to keep interest rates well below the real rate of inflation for a very, very long time because of the over-indebtedness of our country, and the debt servicing costs of our U.S. government would absolutely, it would be a hockey stick sort of debt servicing problem for them. For every 1% in real rates, the U.S. federal government will have to pay roughly $180 billion per year in extra debt servicing costs. So the Fed is really, they're not independent. Even Arthur Burns from the 1970s said, look, the Fed can stop inflation. The Fed can put it in its tracks. But the problem is when you have a government that's over indebted, the Fed really is stuck. They can do nothing more than sort of keep the chicanery going for the federal government. And so that's where our Fed is they can't do much for raising interest rates too much over time. But I think the Fed has also put themselves in the corner where at some point they're going to have to raise rates. And one of the big risks out there, I think, for rising rates, where they might have to raise a 1/4 basis point, maybe up to 1/2 basis point at some point going into next year. I don't know when. No one knows. Even Janet Yellen, she gets a bad enough data. Of course, she'll hold on rates and she won't do anything. But one of the big risks that people need to be aware of, and that's sort of off most people's radar, is that with all the problems that China is having, which are enormous. Remember, they haven't done their own official version of quantitative easing yet. And look, when we did QE1, QE2, QE3, it just jacked everything up. China hasn't even done QE1, and they still have that in their pocketbook. And so if China goes on a really hardcore easing program to soften their real estate blow and to soften their stock market blow, well, what's going to happen is that's going to lessen the effect. Remember, when Janet Yellen didn't raise rates last time, she said it was because of international concerns. And that was just before that, Wang Yi of China, the finance minister, asked the U.S. for financial stability around the world. What Wang Yi was referring to, it was if Janet Yellen began raising interest rates with all the turmoil in international markets, the amount of flow out of emerging markets and even developing international markets into the U.S. dollar would have accelerated. It would have strengthened the dollar even more and wreaked more havoc in international economies and their currencies. And so if China starts QEing and they sort of soften the slowdown in their GDP and their economy, it will actually strengthen sort of the perception of China, though we all know printing money's a bad thing. Long term, it can give a short term effect to stabilizing China, which will force Janet Yellen's hand to raise interest rates, possibly, up to 3/4 basis points by the end of 2016. So while I don't think they can ever raise rates anything dramatically, we've been sitting on the zero bound for 6 or 7 years now that creates all kinds of misallocations of capital. Everyone's scared to death on what the fallout's going to be once they start raising rates. And so the big trigger we need to look for is China. And if China starts softening and start their own version of QE, watch out, because Janet Yellen will have no choice to at least raise by 1/4 basis point, whether that's possibly December, possibly March, who knows. But what happens is with us sitting on the zero bound for so long, even a 1/4 basis point, half a basis point is pretty much baked into the cake. You can see about a 10%, potentially more, right, hit to financial markets. And the first thing that gets hit, believe it or not, are non-dividend payers, because if you own something that doesn't pay a dividend and you can get a higher rate of interest, you're going to sell that because the opportunity cost is better somewhere else. Mm-hmm. The next thing that gets hit, believe it or not, the hardest are high dividend payers. Right, not dividend growers, but high dividend payers, companies that pay 80, 85, 90% of their payout ratio in dividends. They get hit the hardest because when you have this kind of zero bound for so long, people are chasing yield. They need interest. They can't get it in CDs. They can't get it in cash. They can't get it in short-term bonds. So they move out on the risk curve and they buy the higher paying dividend companies that aren't necessarily growing companies with growing dividends. They just pay out almost all their cash flow to dividends. And so those are the companies we need to be sort of more skeptical of if the Fed does have to tighten. But the thing is go back to follow what's happening in China, because that's going to determine a lot what Janet Yellen may have to do, notwithstanding what's happening in our economy.
That's interesting because China is one of the biggest gold buyers. It's a lot of demand has been coming from the commodities. I was just at the New Orleans Investment Conference, and I got to say, there were a lot of people who specialize in resource stocks that were not bullish on resource stocks. They were either holding cash. One of them, Agora, which is like the largest financial publisher in the world, this guy said he wrote an article on coal, and they actually kicked it back. They rejected it. Agora told them, no, we don't want you writing about this. That's how hated some of these resources are. Do you think, the resource sector is a good buy here, or do you think that because of all the things that are going on in China, that this could linger on for a few more years?
Well, that's funny about Agora, right? They know their audience is not going to be receptive to it, so it might have been a great investment idea, but don't send it out because no one wants to read that right now, right? That's Mr. Market being manic depressive, right? And it doesn't create eyeballs when people when you have a beat up sector. People don't like to hear about beat up sectors. People generally want to invest in things that have been only rising and going up, and so that's why people have long-term disastrous results when they manage their own money. So what's going on in the resource sector? Yeah, I think you just have to be really selective, but there are some good companies that are selling dirt cheap that I think have some long-term really good value.
Do you
So,
still use the value? I mean, when you do you speculate? Do you focus on dividend-paying resource stocks? What is your preference to the resource sector?
well, to be honest, I don't have a lot of exposure there, only because they're very volatile industries, and it's hard to sort of put valuation on cyclical industries. But the time to invest in cyclical industries is when they're beat up. Let me just tell you two resources that have done a lot of research on. One is oil, because it's such a important part. It's basically what greases the world and keeps it rolling, because just about everything at the end of the day is some sort of byproduct of oil. So I've done a lot of research on oil. And oil is really interesting. I have not much exposure there, but what's really interesting to me is in the 1980s, the oil had a huge sort of, the price of oil crashed, and it caused all kinds of problems within the oil industry. But at the time, OPEC was sitting on 23%, in spare capacity, meaning they just had massive oil just sloshing around. And that kept the price of oil for a fairly prolonged period of time. And that was in the last 30 years, one of the longest periods where oil kind of went down, stayed down. We're nowhere near that type of capacity in the world today. OPEC is sitting on about 4.5% of spare capacity, including Iran. And so there's not a lot of spare capacity. And anytime oil has typically boom and then busted like this, the 18-month returns from the bust are generally really, really attractive. And so I've been doing a lot of research on oil names. I have very little exposure there. Actually, I have almost no exposure there, but that could soon change as this continues to develop and the spare capacity comes down, because the net new oil production is actually now declining. And so that bodes very well if you have a longer term view. But that's a key resource, and so I do some work there. And I do own a miner that I believe in, and I'm not a big mining fan because of the long-term returns on capital are very, very poor. Over the long term, most mining companies don't earn their cost of capital, which makes it a bad long-term investment. But in this boom bust cycle that you see in the resource sector, they've been busted. And when they've been busted and there's fear and there's loathing, and people like Agora don't want to send out emails on potentially solid investment ideas just because people don't want to hear it, that probably is an area that you should be looking into, because the prices are probably deeply discounted. And so
the nuts and bolts of some of these companies out there, it's ridiculous. Like the mining mill and the facilities are like worth 5 times the market cap, and that doesn't even get into the stocks themselves. Well, hey, last question for you, sir. At FMT Advisory, what is kind of your passion, and what is something that you see when you talk to people or help people with their personal financial model? What is something that you see that is kind of missing from a lot of portfolios, or what is broken out there in the average portfolio that comes across your desk before you've had the chance to fine tune it?
That's a really wonderful question. And actually, what I'm passionate about is what amazes me that people are totally missing in so many cases is their money has almost no exposure to something I'm actually really passionate about, which is interesting to me. That something that I'm really passionate about, something that has worked for decades and centuries, and yet people have very little exposure to it. And what is that? That's amazing companies where you have great, what I call super investors, money managers, essentially running publicly traded equities that know how to allocate capital, that sit on unbelievable assets that generate substantial free cash flow that can be reinvested at high rates of return. And it fascinates me that a lot of people aren't afraid of cash or they're not afraid of gold, but they're afraid of owning a company like Air Products and Chemicals, which is a company that I adore. It's raised its dividend for 30 straight years. You've got a CEO that's put $13 million of his own money into it. And when you own a company like Air Products and Chemical, you own a significant percentage, along with the company, of 1,800 miles of pipeline that is impossible to replicate, even if I gave you $1 trillion. So they have a wide moat business that has high unlevered returns on capital, a growing franchise with a growing dividend, and yet, these are the types of businesses that I don't see people owning enough of, or any of. And, so I think the biggest mistake I've seen that out there is people have a barbell strategy. They're gold or they're cash or they're gold, the resources, or they're just outright afraid. But what in the world are you afraid of owning a percentage of 1,800 miles of pipeline with high returns on capital, with one of the best capital allocators in the industry, the dividend that has grown for 30 straight years, that's got a 9% distributable free cash flow yield. So I would say that I love the question. It's a great question. What people need in their portfolios, I believe in having 4 key pillars. I believe in, you say something on your Future Money Trends publishing site all the time that I absolutely adore. What you say, and you've said it numerous times, which is, plan on the worst and then live your life. Well, at FMT Advisory, I kind of have twisted that around, but I'll give you credit for where I got it from, because it's your origination. But I say, hey, look, plan on the worst, but then invest in the best, right? And worst case planning is owning some liquid cash. If we go into a Harry Dent style depression, you only need 15-20% liquid cash, because the purchasing power of your cash will go up 700%, which will cover the rest of your entire portfolio, even if it went to zero. So do that, and then stop worrying about it, right?
Yeah.
Then own some gold and some silver, because it has historically worked every single time from these financial metrics in 3 to 5 year time horizons from where we are today. Could start working tomorrow, could take 3 years. But now you've protected yourself from a super, inflationary time like the 70s, or even in the early 2000s. We had high inflation in oil and housing prices. Gold was great. Gold protected you in the Great Depression. So you've done some worst case planning there. You've protected your portfolio from the Great Depression. You've now protected your portfolio from, super hyper deflation or inflation with some gold. But now move out. Start investing in some best, some good income ideas, some great businesses that have growing dividends, some great businesses that are run by super investors like Martin E. Franklin that generated a 5,000% return, 50x over 14 years in his last venture. And he's got 2 new ventures that I'm investing in for my clients. And so plan on the worst, folks, and then start investing in the best. That would be my number 1 recommendation today.
That is, I'm going to leave it right there, because that is truly one of the best things that I have learned myself. And you're right about that. Usually people are all in on, they're either all cash or they're all physical precious metals. It's hard to find that medium, and really the best medium is just find amazing businesses. And we call it on the newsletter forever stocks, these companies where we start off with, before we look at anything, will my grandchildren be doing business with this company? And that, if the answer is yes, then we can proceed and start to look into the rest of the company. Well, hey, Nicholas Green of FMTadvisory.com. Join the new personal finance revolution, personal finance and investing for the new economy. Nicholas believes the 1980s portfolio model is broken. So check him out, Nicholas Green, FMTadvisory.com. Nicholas, thank you so much for joining us. You have a great day, sir.
Hey, thanks for having me. Have a great afternoon.